HIMS beat earnings but dropped after hours. Today I'm going to explain why I think they dropped, something really important in the report, and what I think is going to happen in the medium to long run. So to start off, HIMS reaffirmed their guidance, raised the adjusted EBITDA guidance a little bit, and they introduced targets for 2030. The first thing I want to say is HIMS has been known to guide conservatively, so rather than raising their revenue guidance and just affirming it, I think the market is a little bit disappointed in that. Another thing to note is they had revenue of $586 million, but for next quarter, they're expecting a quarter-over-quarter revenue decrease. Not only that, they're expecting an adjusted EBITDA decrease and a margin decrease. Now, obviously, this is just a quarter-on-quarter thing. It doesn't highlight the long-term business goals they have. But I think the market has always punished hyper growers where their growth slows even a bit. And this quarter-over-quarter decrease, while not meaningful in long-term, is a little bit ugly. So with that being said, their valuation is kind of demanding and their growth definitely makes up for it. But with the massive decrease in their earnings for the next quarter, it kind of makes sense why the market wouldn't be too happy. Now, I'm not sure if it's going to hold tomorrow, given this kind of has meme stock power, kind of like Palantir and such, but we'll have to see. As for their dilution, I think this is one of the problems, and I don't think the market's liking it very much. As you can see, you're looking at quite the increase compared to last year, 15 or 17 million extra shares. And obviously that's not great. Some people might think that's not a problem. I mean, if you were to look at Snap, for example, everybody would cry and scream, oh, there's so much stock-based compensation and dilution. And if you look at HIMS, it's actually worse. So that's something to keep in mind. But yeah, other than that, the main thing that's really interesting and extremely disappointing in my opinion is if you look at their subscribers, you can see that they were kind of trending up with personalized subscribers by about 200,000 per quarter, and that trend continued. Now you might think, oh, that's pretty good quarter-over-quarter increase, but you gotta keep in mind, quarter one is where they had their Super Bowl ad. To spend that much on marketing and have this very mediocre increase, like a linear amount, which is less as a percent, is incredibly disappointing. So that being said, I don't think HIMS is a bad company by any means. I think it's a decent company and it has decent potential, especially with it having a cult-like army. But one stock that I like a lot better in a similar sector is a much smaller company called Hydrate. Why I like this company is because rather than just having direct-to-consumer, they have people to deliver the services kind of like in an Uber for nurses style way. They have the brick-and-mortar white label solutions, and they empower others to do direct-to-consumer kind of like Shopify. So HIMS has great margins due to a lack of competition because there's quite a lot of regulation. Hydrate empowers others to compete, and there's about 30 businesses under Hydrate. So as you can see, their revenue is significantly smaller, their market cap significantly smaller. They're a very small business, but that's just right now. I think this company is very likely about to explode in terms of their business, and I think it's definitely worth looking into because I do believe this has 1,000 times more potential than HIMS. If you guys are interested, they will be hosting an earnings call tomorrow. It's going to be a live call at 1 p.m. Eastern time. So you guys can even ask the CEO questions if you'd like, and he will respond. So that's all I have to say for today.